So one of the questions that I get a lot is how do you go about getting a commercial loan or a portfolio loan? Well, there's nuances in the difference between commercial and portfolio. I'm going to use those two terms interchangeably through this talk. So basically, portfolio loan is something that a loan product that a bank is going to hold in its holdings once it sells it out to you, rather than selling it off to another lender. So a lot of times if you go get a mortgage, you'll walk into a bank, you'll get your mortgage, and then once that mortgage is complete, you've purchased your house, the bank then sells that mortgage to another lender who services your mortgage for the duration. Whereas a portfolio loan, that bank that you go into to get the loan, they're going to keep it in their portfolio. One of the reasons why I use commercial loan sometimes instead of portfolio loan is that the commercial banker at the banking institution, credit union, whatever, that's going to be the person that's going to help you get that portfolio loan. There's different levels of commercial lenders, but you'll have anywhere from loan agents to VPs at the bank, depending on the size of the bank. But commercial loan, portfolio loan, it's a loan product that the commercial lender is going to help you, and then they're going to keep that loan in their portfolio at the bank. So as you're going about getting your first portfolio loan or commercial loan, it's kind of the process walking into that. So I cold called a few banks on my own and got different terms that varied pretty widely from bank to bank, but I had the most success whenever my CPA contacted a commercial lender directly at a small local bank, and he was able to make the connection, and we were able to get a loan product that worked for me, that was going to cash flow enough that I could put this deal together and be happy with it. So what is that? Why I was able to get that loan with a CPA introduction and not by myself? A lot of times when you go cold calling, you're going to be talking to loan officers at the bank, whereas the CPA is going to have connections with higher level people at those institutions that they can get you plugged in directly to somebody at a VP level at the bank. The other thing is the bank's portfolio. So some banks may be fat on residential loan products, but they may be looking more avidly for small business lending opportunities, whereas some banks may be pretty extended on business opportunities, but be looking to expand their residential holdings. And your CPA, through his relationships with local area lenders, should have a good idea of who's looking to lend on the type of product that you're trying to borrow on at that time. So that's another way, not only the level of access that a good CPA will get you, but also connecting you to the right people at the right time for the loan product that you're looking for. Right off the bat, one of the things that is different about a commercial loan is the loan to cost and loan to value ratio. So when you're taking out a mortgage or some other loan, you're used to having to have an 80% loan to value ratio, meaning that you're going to need a down payment of 20% of the total appraised value of the property. So as you walk through that process, you get an appraisal on the property, the lender offers you 80% of the value, you put up 20% of the value. With a commercial loan, it's going to be loan to cost. So regardless of what the property or portfolio of property is appraised at, the lender is going to loan you some percentage of the total cost you're actually paying for the properties. So in our hypothetical example, let's say you're buying a $600,000 portfolio of properties. However, you're getting these at a discount, so your actual cost is $500,000 for this portfolio. Well, with a loan to value ratio, you would be paying 20% of the $600,000 as a down payment. So you would be looking at approximately $120,000 down, which if you're only paying $500,000 for the properties, then you'd only need to come up with another $20,000 because $100,000 is already in the discount that you've negotiated. However, with a loan to cost, the properties may appraise at $600,000, you're only paying $500,000. However, you need to come up with 20% of the $500,000, which would be $100,000 for the lender to only give you $400,000. So So you can see right off the bat how with loan to value and loan to cost, whereas with your mortgages, you may have captured some of that down payment in the actual appraised value being more than what you're actually paying for the property. However, with a commercial loan, don't expect for that to hold true. Expect to actually be negotiating your terms off the loan to cost rather than the loan to value. So now that we've covered that difference, another difference is amortization rates. So with mortgages, you're used to either picking a 15-year amortization or 30-year amortization. Don't expect for those 30-year amortizations to be available with commercial loans. 25-year amortization is actually pretty generous for a commercial loan, with 20 years or shorter being typical. So what does that mean for you? Obviously, since your payments are distributed over a fewer number of years, you can expect that there's going to be higher payments involved with a commercial loan rather than a collection of individual mortgages that you may be used to. Lastly is terms. So with mortgage type loans, you're used to your terms being equal to your amortization rate. So if you have a 30-year fixed rate mortgage, you're going to divide the price of the mortgage over 30 years, and you're going to continue paying that price for 30 years for the principal and interest portion of your mortgage. However, expect that with a commercial loan that the terms are going to be somewhere between 3 and 7 years, with 7 being on the generous side, 3 being on the shorter side. So basically, as you get into that commercial loan product, you are going to have a balloon payment at the end of your term, at which point you'll either need to sell the asset or refinance the asset on another term, or have some other solution for how you're going to deal with that payment. So, quick recap: loan to cost versus loan to value, amortization rates, and terms are 3 things that will be a little different going from hard money or mortgages into a commercial loan product. Another thing that's difficult when you're talking to people about a commercial transaction or a portfolio of residential transactions, even talking to other real estate investors, is that everybody has the context of purchasing a single-family residential property with either cash, hard money, or a mortgage product. And so you're used to finding them in traditional ways, or even just slightly less traditional ways like wholesaling. So a lot of people ask me, like, how do you even find a portfolio of homes like this? Well, the way I found a portfolio was I was looking in the market that I was interested in purchasing, and I saw wholesalers that were actively trying to purchase homes. So rather than reaching out to the wholesalers with a purchase, I reached out to the wholesalers as a buyer and asked them if they could include me on their buyers list. Well, that promptly led to one of the wholesalers I reached out to replying with a portfolio of homes that he had to sell. This particular wholesaler was looking to get out of the market that I was trying to get into. And so I said, yeah, I don't know that it's something that I'd be able to purchase right now, but definitely is something that I'd be interested in. So he sent me the portfolio, and I had an opportunity to look it over. So that's how I found the portfolio of homes. Another thing that's different about purchasing a portfolio of homes over an individual home is you're probably not going to work with a real estate agent or a broker when you're buying a portfolio. Although in some markets a portfolio may be listed with a real estate agent or a broker, a lot of these portfolios may be off market, like the one that I found. The wholesaler was interested in selling them, however didn't want to scare his tenants by putting these homes on the market for a prolonged period of time. So with it being off market and there not being a real estate agent or a broker involved, but you still want the process to go smoothly, I enlisted the help of a lawyer that I've done a lot of work with in the past on real estate work. So rather than paying a broker's fee or a real estate agent's fee and commission, I'm going to have legal fees through the document review process and the actual processing of this transaction. One of the nice things that comes along with having a lawyer helping you process the transaction is that we've established a secure share drive where we can consolidate all the documents going into this transaction. So as we get appraisals, as we get home inspections, as we get title work, we get the tenant's leases, we get tenant applications, all those things. We can compile all of those documents coming from different sources into one consolidated shared drive that's accessible to whoever needs access. And it's also well thought out the way the folders are compiled, so if we need to bring in one person, like a lender or title company or insurance agent, into one specific aspect of the transaction, we can just grant access to that folder so that person's able to do the work they need to do without compromising the rest of the data. So getting the portfolio a little different than the way you might find a normal real estate transaction. The processing a little different by using a lawyer rather than a real estate agent or broker. And then insurance is also different. So as you go through accumulating properties 1 to 2 at a time, you're used to just calling up your insurance agent, getting a quote, and getting insurance on that one property. However, a lot of insurance companies will limit the number of renters policies they write to 5 homes per individual. So the way you can make sure that your investment is still insured in a streamlined manner is by getting an insurance product where it's one insurance policy. However, there's different declaration sheets on every home that you're buying. So the way I did this was contacted a local insurance group in the market that I'm going to and let them know that I was buying a portfolio of homes and I was looking to get an insurance product on all these homes, and they were able to help me out with that and have quotes back within 48 hours to include income replacement on the properties. So if you have a renter's policy, you're probably already, or a rental property insurance policy, you're probably already familiar with income replacement, but very important to have on your properties in the event of catastrophic loss. The income replacement will continue paying your rent during the time that you're repairing or rebuilding the home that was lost. And I personally have used this, and it's definitely something I would never go without. So now that you've connected with your commercial lender, you've already established that you want to take out a portfolio loan with their institution. What is the actual, borrowing that portfolio loan? What does that actually look like? So one of the things that you're going to do is, just like you did on mortgages or other loans in the past before, you're going to make sure to fill out a personal financial statement. That personal financial statement is going to have everything about you: how much money you make, your work history, savings, other liquid and non-liquid assets that you hold, and other debt that you have. So once you fill out that personal financial statement, you can expect that it's going to be accompanied by 2 to 3 years of tax statements that go into the bank. So this is where your professional reputation as a real estate investor on the wholesale deals that you've done, the flips you've done, the rental income, properly accounting for that with your tax statements really sets the tone for your professionalism as you go to take out one of these loans. Unlike previous loan applications that you've done in the past with a commercial or portfolio loan, that loan is going to go through your loan agent to a board at the bank, and there's actually going to be a loan board or committee that's going to look at your loan application in its entirety and decide the amount and terms of the credit that they're going to extend to you, if they even extend credit to you at all. So once you've put together that application, that package, you've gone to your lender, and that loan has gone to board, that's when you're actually going to be offered the terms and conditions of the commercial loan product that you're trying to get.